Alright, welcome back to our fourth video on our Model 51 breakdown series. Today we are going over structure. We're going to be talking about the intermediate time frames and how we time our executions on the lower time frames.
So since the higher time frame is bullish, we are going to be looking for longs. So we're going to drop down on the hourly, which this is the hourly. We're going to be marking out the range high. We're also going to be marking out the range low. And we're going to get our Fibonacci and mark out the PDR rates or the imbalances that can be found in the equilibrium of the range. So we can see we have two hourly FVGs here. This is a good place to long. We're going to wait till price comes back into this FVG and see what happens then.
So looking at that recent candle, we can see that we wick off of the equilibrium point inside that PD area, and we want to see an expansion upward. So if we were to drop down into the 15-minute time frame, we can see that we do get that expansion upward. So not only do we get the expansion, we also get an entry opportunity. We get an IFVG, and we also do have a unicorn there too. So we can mark out the IFVG. So we also have the drawn liquidity being the buy side liquidity up there. That's where we believe that price is going to head to. But price does end up going to 2R, and that's how much we target on all of our trades at the very most. So that would be the position entirely. Okay, so that was how we analyze the intermediate time frames and how to time our trades. But before we get down to our entries, first we want to talk about news and session opens, which we're going to go over in the next video. So next video is going to be all about red folder news and the volatility that we need in order to execute our trades. So we'll see you there.